All right, welcome back. This is episode 33 of the LongVol Show. The title of this week's show is Ahead of the Curve. As we get closer into September, you have the Fed rate cut more than likely happening here. We want to talk about this idea of being ahead of the curve. My name is Dan Bustamante. I'm the founder of the LongVol.com and the LongVol Report. We publish a report every Sunday tracking over 50 tickers, long, short, cross asset in 4 different stock monitors. You can get a free 21-day trial by heading over to the longvol.com. Click the memberships tab. You can take the trial there to see what it's all about for 21 days. So let's get into the show this week. This is going to be a little bit of a shorter show. Normally they're about an hour and a half. I think I'm going to be about an hour based on expectations, primarily because this week wasn't too busy. The markets are pretty much on autopilot at this point. I'll share with you guys in this show. We'll just start it here. Look, until the Fed meeting in September, most of this stuff should just kind of be, again, an autopilot. I don't think there's going to be too much going on. You're probably going to get some shakeouts, some breakdowns. Some of the weak hands will get out. Some of the data we have to continue to watch. But at this point, and I'll show you my kind of backing up the thesis here, the Fed's going to cut September. They are. Now, what that translates into for investing is an entirely different discussion. And that's part of the show today, talking about being ahead of the curve, because people from a generic, again, you heard the term NPC. If you don't know what it means, Google NPC. There's a movie with Ryan Reynolds, if you haven't seen it, where they talk about that idea. But most people, I think, they think rate cut, stocks go higher, all is well. Okay, that's not necessarily the case at all. And I'll share my views with you on this show. Okay, so we're going to get into it here this week. I will be in Vancouver at the end of September from the 24th through 27th or 8th. I forgot the exact date. I'll be at a small cap penny stock, not small cap penny stock, small cap and penny stock conference. And then in September there in Cole Harbor. I used to spend pretty much every summer there up until COVID. I have a lot of friends there. I'm going to meet with a client as well. So if you're there in the Vancouver, or the BC area, and you want to meet up for coffee, interested in talking markets or about our firm, happy to meet with you. Just send me a message. I will be staying at the Fairmont in Cole Harbor. So that's the area I'll be in. I'll probably be in Yaletown for dinner 1 or 2 of the nights, because my favorite sushi spot pretty much anywhere in the world is there in Yaletown. So I'll be there as well. Okay, so that's where I'll be in September. This is the end of the month of August. It's been a pretty good month, depending on what sides of the trades you were at. It's been a good month for us in our report. It's been a good month for us in the swing trade performance as well. So again, if you're not a subscriber to the report, you get access to our swing trade portfolio. We've had another monstrous month of August. These are all open positions right now. They're not closed. The ones that have closed so far for the month of August have all been positive. Schwab, we closed in August. So I guess it'll count as the loser there. But so far, this first start of the month, we've crushed it. And we have 1, 2, 3, 4, 5, 6 open positions right now for the month of August, which again, normally there's 2 to 5 a month. But right now, you'll see in the show today, the markets are at a point where things are coming alive, both long and short. And there's a lot of action going on. Okay, so it's a lot more clear of a picture. A lot of money will continue to be made, not only in this, but also for the clients that we work with that are accredited investors and qualified institutions. So again, I'm excited for the next 2-3 months across the board. But August was very good to those of you that are subscribers of the report and get access to the swing portfolio as well. Again, if you're not a subscriber to this, literally just go to the memberships tab. You can click on LongVol Report. It'll take you to this page there. You can try it free for 21 days. Okay, it explains how we do everything there. Just click it. It'll explain everything to you. Okay, so that's been the month of August. September, Vancouver. Send me a message if you want to meet up. We're always looking for new clients, and like I said, Vancouver is one of my favorite cities in the world. I'll tell you guys a story about it when I'm there at the end of September. Okay, so again, if you're new here, make sure to watch watch here and subscribe. You can also listen on Spotify as well. We do the same routine every week. We go over articles of interest of the week, broad market discussion, S&P, NASDAQ, and we give a specialty kind of note each week. This week is ahead of the curve, and a Q&A for the week. So you're going to want to stick around this week. A lot of questions came in this week that I'm going to address from readers of the report. The past 2 weeks, I've got a lot of day trading questions. It's not really what we do here. Not really what I do much of more anymore, for those of you that have followed me for the past 10 years. We're more long short equities, investing in companies now. with our firm and for the fun. So that's what I do. But this week's questions were great, and I'll answer those at the end of the show. Okay. So the quote of the week comes from the legend Howard Marks. If you're not familiar with this guy, I would read his books. Even if you're a day trader or short-term trader, I'm telling you, all this will do is help you gain perspective. Read this guy's book. Okay. Step away from your 10 monitors for one day. Read the book. I promise it'll help you to gain perspective. Investment success doesn't come from buying good things, but rather buying things well. Okay. This couldn't be more true coming out of this cycle. Um, I talked about this 3 months ago. I'm going to explain it here in a second. Okay. There are a lot of names we were filtering for in April and May and June. And I didn't just want to go out and randomly buy metals and miners companies. I started to dig and see which ones are going to perform the best. Okay. Because if you have an idea a sector is going to do something, you can either build a basket of those names to create your own ETF, or you can buy just the best of breed in that sector. Okay. So buying things well is extremely, extremely important. Okay. Even for you traders out there. And I'll give you a quick example. Uh, Brian Agile Gnome, who leads our active trader. It's this new thing we're testing with. Again, some of you are just still actively trading or trading part time. We're in the same office and I live on the island. Okay. And, we trade and sometimes we'll go through in our personal accounts and, we short term trade. And there'll be positions we put on. And I go, we didn't size that position well enough. Okay. We should have sized it correctly or we should have did this differently. So not only does it matter from short-term trading, but also it really, really matters when you're investing in markets. Okay. And this couldn't be more true coming out of this cycle, not only because he talks about business cycles, but also because right now, and really for the past 2 months, constructing a portfolio coming out of this cycle, if you have the capital, by the way, is probably more important than ever. There's going to be fortunes made out of this. I'm excited because our firm is open finally. We're onboarding clients, and I'm excited to make our clients a lot of money. So this is, again, if you're not excited about this next 6, 8, 9, 12, 24 months, you should be, because a lot of things are happening here, whether you realize it or not. And again, just pay attention and you should be able to make some money. Okay. This is the article of the week. This is from Carlo Canel of Canel Capital. Again, I'll give you a quick thing. Look, I cannot suggest this video enough. I'll say a quick few things here. Number one, watch all of this. I don't care if you're short-term trading, you're an investor. This guy is a legend. He started his firm in 1992. He's hilarious. Okay, I really watch this and pay attention for a few reasons. Number one, they managed close to $1 billion. He's crushed it for over 30 years. Number two, nobody pays attention to this stuff. This has a 967 views, and it was done a year ago. This guy is a legend. Okay, but you're not going to see him on CNBC. You're not going to see him, in a rented Lamborghini or on Instagram or YouTube, back testing and making up all these strategies to basically be a hamster on the hamster wheel. This is really, really good information in this video. And it has 967 views. It's a travesty by all accounts. Okay. I posted in our Delta One community today and to a couple of investors I'm working with out of Europe. And I explained to this section in particular where he talked about his due diligence process into here. Look, he's not giving you all of the recipe, but he's pretty much laying out a lot of what they do. Now, again, you need a lot of money to do what they do, of course, but you can take some of the frameworks and mentalities that they use to go about it and apply it in your own investing. I'm telling you guys right now, this is free. It's an hour long, and watch it 5 times. Seriously, watch this 5 times. Google the guy's name. Read some of the things he's wrote to. He's used to be an activist, still is sometimes. Read and see how he looks at the markets, or read and see how he looks at companies. Okay, I'm telling you, this will give you a perspective shift. And for a lot of you out there that are still, again, some of you are going to be on that train, stuck on the day trading only thing and the back testing nonsense. Eventually, you're going to get to the point where you're going to want to make serious money. And paying attention to guys like this that are extremely smart will help you to do that. That'll be your article of the week. Okay. So that's that. Let's get into the main topic of the show this week. It is ahead of the curve. And speaking of being ahead of the curve, that guy's always ahead of the curve, which fits in perfectly with the show this week. There's a saying that goes, being early is the same thing as being wrong. Okay. A lot of people in this business are very egotistical. They're always early, but they're never wrong. That's a saying as well. It's true, but they're like anything, there are exceptions to the rules. And given this tightening cycle, being ahead of the curve was, is, and will continue to be key. Okay. If you don't understand the cycle we're in, Go get the Howard Marks book. Read it. Okay, read it in 2 days. So you understand what I'm saying to you. And don't brush this off for those of you that are new here or think it doesn't matter. You're missing such a large, massive piece of the puzzle to investing. I don't care if you're day trading either. Okay. If you don't understand what's going on with money managers across the world and you think I don't need this, you do. Okay. It'll only benefit you. And I say this all the time, and I've said it for 10 years. Back in 2014, some of you guys know me. I started an education company. I would try to teach a lot of the traders that came in to think differently versus just back testing and their little indicators and their 1 minute candle charts and all this nonsense, but they're too hard headed to ever listen, most of them. And they were so stuck in their tunnel vision. I'm going to do it this way. I'm going to do this way and make money. If some of them just read this and some did, the amount of success would have been drastically different for a lot of them because it gave them perspective. And some of them did read this and gain perspective. One of them I'm meeting with next week. She's now a financial advisor, runs close to $60 million. She just started 4 years ago at her firm running it. And she was one of the persons I kind of taught about this, and it changed her entire perspective. She started an online trading academy, and some of you did as well. And all they taught her was technical analysis. And I'm not saying we use price analysis as well in our investment processes, but she only looked at the market through charts. She didn't understand any of this. And once you understand this, I'm going to point it out to you here in the show today. You should have light bulbs go off. You should come back to me or send me an email like, holy crap, this has changed how I looked at everything. And if you don't have that epiphany or that happen to you, you're still not making it click. Okay. So I mentioned this piece here I'm going to get into, which we're going to read here in a second. A few months ago, the title of the article of the week was An Inflection and China Third Plenum. I wrote this back July 10th. We're going to read through it here now and explain to you why being ahead of the curve matters. All right, so this is what I wrote. We are at an inflection point in this cycle. What that means in short is you're at a turning point. So just another way, but I guess a better way to describe it, okay? And the data of the last 2 weeks. So there's a lot of data that came out back at the end of June. CPI prints were really important, okay? Basically gave the Fed cover to do what they needed to do. Basically saying, look, what we've done the past 2 years is working. There's going to be a Fed cut imminent. So then you take this information and you start second order, third order thinking. Okay, if you're not familiar with that term, just Google it. But you start trying to figure out of this rate cut cycle, what comes next. Okay, the problem was, and still is to this day, I'm going to show you this week here in a second as we progress in the show. Everybody back then was, is it the market top? Is it the market top? CNBC, what do you think, Jim? Is it the market top? Show me your stock chart. And everybody's running around like, don't share this stock chart. It's a very secret one. I'm the only person in the world that sees the S&P talking about market tops. Nobody cares. The question that should have been asked and should to be asked going forward is, what companies are going to be in play out of this cycle ending? And then preparing for it, okay? Not whether it's a market top. This is the continuous conversation that happens with people that aren't really involved in the markets, people that don't really make any money in the markets, people that do this as a hobby. This is discussion and narrative they feed you. Okay, like anything in life, and I'm not putting my tinfoil hat on here, but you've got to understand this, and if you don't, you need to at some point or another. There's narrative that's driven out there. There's narrative about day trading in the markets, okay? Most of you, when you go on YouTube, what do you see from the day traders on YouTube? They try to sell you guys on day trading either stocks or options, and all you need to know is support resistance, and that's the entire thing. And then they give you ARB multiples. It's literally the same thing regurgitated over and over and over and over. Okay, it's the same thing with investing in markets. We always talk about market tops. But back in end of June and July, that was the inflection. That is when the Fed is going to cut interest rates. Okay, I've said this before. The past 2 years when we started cutting interest rates, if you heard me, you're probably tired of hearing me say it, but I'm going to say it here again. What the Fed says and what the Fed does matters for every asset class globally. I don't care if it's Bitcoin, real estate, art, cars, companies, stocks, private equity. It all has a cause and effect. Pulling on the lever of interest rates and credit across the world matters. A failure to recognize that is deadly. Okay, now there are certain companies and asset classes that are less affected. Okay, but some, or typically most, are affected by it. Okay, but you cannot control the timing of the central banks. You can't, but you can certainly watch for clues and put together a list of companies or sectors you want to see perform out of a tightening cycle. It's a big reason I'm a fan of Howard Marks and his thoughts on the business cycle. And given the last few weeks of data, I think we're at a sea change, which he calls it, okay? or an inflection in the cycle. Okay, he wrote a piece called Sea Change. Same thing, just different, describing it differently. Okay, the way we do it at our firm, we start picking positions, 8 to 12 positions, and start to develop those into the portfolios. Okay, I wrote this back then, talking about this entire thing there. In fact, let's just go back. I'll pull it up here and go through it. This is where I wrote it. You can go back and read it here. Continue to go on and say a few things here. So when I say I don't care where the S&P or NASDAQ is, really, I mean, I don't care where it is. I do care in larger interests. We put on long short portfolios, which we did. We were short the NASDAQ and S&P. And that sell off in August, that's the only reason I cared about it. The last 2 weeks of the data has given the Fed the cover they need to cut in September. And September is looking like the time to do it. That's the inflection point. And like a hurricane, we're all in the eye of it right now, whether you realize it or not. Some people just didn't realize it because, again, they don't understand where we are at all in this cycle, or that a business cycle even exists. Okay, and again, there's nothing to be ashamed about. If you're new to this, like I've been doing it forever, of course I understand it's easy for me. As you do year after year after year, it becomes easier and easier and easier. But you need to incorporate this into your game, into your business. Okay, it matters because every asset class in the world is affected by interest rates. I don't care if you're trading futures and you think that you found a 1 minute candle system, you're affected by it. You're affected by order flows that come into it. You're affected by the yen carry trade that blew up the S&P the other day. So if you don't think any of this stuff matters and you're still living in your little hollow tube of tunnel vision of this stuff, it's a big mistake. Okay. Gold metals and miners are ready to go. In fact, gold was up dramatically in that CPI print. This was back in end of June. Central banks have been acquiring it again. And I talked about here. Their market inflation opens door to wider September rate cut. Okay, so again, to be clear with you guys, the Fed told you, if you were reading between the lines, they were going to cut basically at the end of June. Okay, to make it real world reality, if you've been in a relationship before, somebody doesn't really want to break up with you, they're going to give you signs. Okay, in my case, maybe a lot of signs. But there's always a sign. Okay, it's the same thing with markets. There's always signal there. You have to read between the lines. They basically said back then they were going to do it. This is part of being ahead of the curve. It's important to investing in the markets. There are a lot of names that were up in the report as well. If you don't subscribe to the report, you can. I kept some of them out of the report. There's some of the ideas that we keep for our clients. I can't give you guys all of them, but there are a lot of in the report that crushed it as well. Some of those names were. We're going to go to the charts. Where TSN, wheat and precious metals, and NEM. They've all pressed higher since the data came out end of June. I'm going to show you here in a second. Again, what the market calls smart money, all that means is it's money that pays attention. That's all this is. People love to say smart money, big boys, right? This is a thing they told my friend when we shoot online trading academy. One of the narratives, which was false, that the big boys on Wall Street, whatever that meant, were moving stocks around. Okay, smart money is all of you, us. If you just want to be smart and pay attention. Okay, and I'll keep hang with me. I'm going to explain this to you as we progress. Okay, if you don't know what to look for, you don't, and you do it long enough, you will. But until then, you can use a report to help you with that. Okay, so let's go to the charts here and show you. This is, in fact, let me go to June here. I'm going to do something here. So this is June. Okay, this is the Russell 2000 after that CPI print. Russell was up in 7 days, 12%. Wheat, precious metals, 21% in 16 days. Newmont Mining, 30% in basically 2 months of trading. And Tyson Foods, which I've been investing in and out all year. I just have another position recently on this. This is the June meeting here. A week after it was up 8%. Since that meeting, it's been up 18%. Now, again, Tyson's got a little bit of inflation or interest rate linked to it, but not that much. There's a different reason for that particular name. The point I'm making is being ahead of the curve mattered. It was important there. So they've all really pressed higher, like I said. Again, the last 2 weeks of data has given the Fed the cover they need to cut. Again, the Fed just needs to see that what they're doing is working. They needed any reason to cut interest rates. So again, if you're still in the camp that I don't know if the Fed's going to cut September, they're going to cut. Okay. Now, what does that mean for investing? Again, it's not just a one-word answer. I think people that don't know, well, just tell me what to do. Okay, look, that's not how it works. Subscribe to the report, watch this show. But again, there's more to it than just that. Okay, this is Tyson Foods. I'm going to talk about this here. This is literally just been another 52-week high. Okay, it's not one of the shiny object stocks like Nvidia or Apple, and I like boring. Okay, I mean into boring companies sometimes because typically they make money. We added this back in January. We traded it back in March. I've been invested in it for some client portfolios for a while. Added to it again this week. In the swing portfolio, for those who have access to it, we talked about it here. And this is literally part of what the report looks like. Again, you can get a free copy of this. That will be a current copy if you can download one. And the information is pretty quick. Okay. I don't believe in 10-page analysis reports. Typically, that's, first year analysts, or not everybody at Seeking Alpha, but most of Seeking Alpha articles are people who write like 3 or 4 pages and they don't even invest, or they have a little bit of money. If you're going to invest in something or pitch something, it's 1 page or less. If you can't decide what an investment is, long or short, in 1 page, you don't understand the investment enough, or number two, there's too much going on and there's probably another better idea. Okay. So the report's pretty quick. We're not writing deep analysis to pretend we know what we're talking about. It's direct to the point. TSM was one of those ideas, and this week it made another 52-week high while we're all worried about Nvidia, et cetera, et cetera. Okay, so being ahead of the curve does matter. It's important. It'll continue to matter into the end of the year and the rest of this quarter, especially with the upcoming presidential election. Okay, revisiting Papa John's. This is another example of being ahead of the curve. This was up 9% earlier this week. We added it to the report back in, I think, May or June. We added it to the report. I laid out this title. It was Papa John's, a turnaround or a dud. Now, again, you can read this. Just go to the article of the week, whatever one was back in June. Just click one of them. It should be there. But I talked about the quick bullet points of this company. The CEO left to Shake Shack. They have some problems on their own, which is a whole different story. Again, revenues decreased. One of the biggest problems they had was their commissaries business. Again, if you don't know how that works, let's say you want a Papa John's franchise, okay? So this is you and your franchise here, and you want another franchise in another city here, and you want to order pepperoni, ranch, and if you're one of those psychos that puts a pineapple on your pizza, and you order that as well. For your store, you order it from the commissaries, and Papa John's makes your money, okay? Their margins for this business were, I think, 4%, I think they said. I got to go back and look at the data. And this is their words, not mine. Those margins compared to industry standard were well below, and they were basically just blowing it. They weren't doing a good job. And what they said was they were going to fix that. Now, again, like any CEO or anybody out there that talks about change, you've got to watch to see if they actually do it, right? Anybody can say, I'm going to do this, I'm going to do that. Now, obviously, executing on it's a different story. So this was kind of a turnaround. We were watching this for a while. It came off the lows pretty well. It was at 26% in 31 days. Now, again, earlier this week, it was up dramatically. It had one of the biggest moves in a while. I couldn't figure out why. There was some rumor back in May when I was looking at it. I was talking to an analyst that covered it, one of the banks, and again, some of the color that was out there that, again, maybe somebody was sniffing around. There was 3G that was talking about it. So I guess their jet went over to the headquarters. I think it's Louisville, or I forgot the state they're in. But they tracked the jet. This basically said, hey, look, they're going to do a take private, which, again, to be honest with you, wouldn't be a bad idea. I'll talk about in a second. But they thought there was going to be a take private. The stock went higher. And yeah, that was kind of it. Okay. If they're going to make a bid for this company, this is the ideal time, in my view. Okay. Again, I'm not relying on that to happen. We own Leap options. I don't own the equity on it yet because I still don't believe in the turnaround just yet, even though the stock's been up. I don't know they're going to execute on what they've said, even though they have a new CEO. But if they're going to take private, it's probably the best time to do it before it's back to 65, 70s. I mean, again, we'll see what they do. It's probably not that quick. But again, they've got to fix their commissaries business. And they said it. You can click this link here to be clear. This isn't my making this up. You can literally click on their IR. And they explained it literally. They dedicated 5 pages to their faults in the commissaries business and how they plan to fix it. They literally told you, this is our plan, why we screwed up. And our old margins were 4%. We're going to get to 8%. Okay, that was their goal. Now, if they get this to happen, this is or is the biggest revenue driver for the business. This is where all their profit, not all of it, but the majority of it comes from the commissary's business. Okay. Now, if they fix this, um, the valuation of the company goes higher. Okay. If they don't, you've got a problem. Okay. But again, like most things in business, um, a lot of companies that are bloated get sloppy. Management starts to stop giving a you know what, and things start to crumble. Okay. Whether you liked it or not, the original founder, Papa John's, I think he did a great job of running the company because it was his. He had skin in the game. It was his passion. He owned the equity. Again, if you know the story, they kind of he was ousted. I don't think he owns much, if any, shares anymore. But it's like any business, right? If you start your own business, you care about it, right? I mean, you really care about it. You put your heart, your soul, your passion into it. You want to build it. When you have people that run a company on the board that don't care about it, just collect their checks, which happens all the time in corporate America. Stuff like this happens. Okay, so we'll see what happens of it here. I own Leap options on it. I don't like the equity yet, to be clear. Again, not investment advice. We only work with accredited investors or qualified institutions. If that's not you, I still want to work with you. Just go to our report, subscribe to it free for 21 days, click the memberships tab there, and you can get access to some of our cross asset ideas as well. Okay. So that being said, let's get into the final part, concluding this about being ahead of the curve. If I haven't convinced you even part of it to consider being ahead of the curve, I'm going to continue to do so here in a second. Okay. Being ahead of the curve matters, especially in the cycle. Patience always pays out if you're an investor. If you understand what you own and why you own it, the technical shakeouts are just that. They're shakeouts. Number two, this always helps to have new ideas, sectors you're watching, and research done. So when a catalyst comes, you can just react. If not, use the report. We have coverage on 50 tickers and 4 stock monitors. Okay. Final point is this: remember, price is what you pay, the value is what you get. Okay. The key is in picking the right companies coming out of this cycle, and it takes some work to find the bigger winners through different screens. Again, I gave you guys a few. I can't give them all away. I will tell you one if you were paying attention out of that. And this was in the report, by the way, to be clear. We were trading it back in April or May. You guys can, I have to look, but Rocket Mortgage is one of them. This is literally the end of the meeting or the CPI print. From that CPI print till there, this was up 61% in 54 days. Okay, 61%. Okay, so paying attention matters. Patience matters. So again, this is why if you guys followed me on Twitter, I poke a lot of fun at the day traders trying to pinpoint every 1 minute move or every 10 seconds, pressing buttons all the time because there's 60% there. I mean, if again you have $100,000 portfolio, you put 10% into that, not a lot of money. You're up, call it 40%, 40%, 4K. Okay, you're not gonna sit there and buy a new Porsche 911 with it, but every dollar adds up. And when you're constructing a portfolio, especially some people that read the report, they have larger portfolios that are putting 100, a quarter million, half a million into ideas. Those numbers add up a lot quicker. Okay, so that's that there. Let's move on to the broad market analysis. Okay, so every week we do the broad market analysis. Like I said, I really don't like doing this, but I know you guys like talking about it, so I'll get into it. And I'm going to keep it brief this week on broad market analysis. Okay, look, I do think you're going to get a check back of price into next week. I'll explain the charts in a second. The Fed's going to cut, but I think there's this idea, to be real simple. I think people think that just because the Fed's going to cut, that stock charts go like this. They don't. Okay, there's other factors involved. Data, you had some GDP data that came out. You had the Bureau of Labor Statistics this week, which we're going to get into in a second, which was an absolute joke. Things that affect the ebb and flows in the markets. Okay. So here are my views into the September rate cut. They are going to cut rates in September. I discussed it above from the post back in June. The market will check back more, meaning sell off and shake out weaker hands. My third view is this: rotation out of the Mag 7 continues. I did discuss this at the end of the third quarter. I'm going to show you here what I said for Q3 in the article of the week. And again, this isn't something you can't learn if you just understand how money flows in markets work. Okay, for Q3 expectations, I said likelihood that the Fed cuts, they need to catch this right in September. Okay, so the point here was the consumer data was deteriorating pretty badly. Okay, and they've got to walk a tightrope sometimes to make sure it doesn't get too bad. And I think they're probably going to get it wrong because they waited too long this time. But again, for those of you guys complaining, they've got to cut interest rates. 3 weeks ago when the market sold off, you had some bozo on CNBC come out saying we need an emergency rate cut. Okay, nobody ever comes out when interest rates are lower and everything's booming and says, "Hey, look, we need an emergency hike." It's only when everybody levers up, like degenerates that they are, in the same trade, the Mag 7 stuff, that people start complaining. Okay, so again, it's just hypocritical in my view. But they're going to cut rates in September. That's my view. Normalization of tech names. Basically, what I mean is that these names would start trading sideways. Now, why is that important to understand? Okay, out of a rate cycle, the money's got to go somewhere. Okay, the trade that had happened was this. I mean, it was literally the easiest trade to just crowd into Nvidia, Google, Amazon tech names the past from last October to pretty much half of this year. That was the trade, and it was a crowded trade. Every hedge fund hotel was in there, and you crowd it. It's gone. So that money's got to flow somewhere. Just like in Japan, the yen carry trade, it's got to flow somewhere. Okay, so a lot of that money's got into small and mid caps, gold miners. The money's got to chase yield. Okay, the entire world is always chasing yield. So for those of you that are watching this show and you're just day trading, you only see the world through one set of binoculars of technical indicators, price levels, and narrow vision. You don't realize the trillions of assets out there that are managed by people that don't look at the world through that lens. They look at the world through yield curves, right? They look at the world through economic data, through macro, through yen, through the carry trade, through dividends, through business cycle. And they allocate their capital to follow yield, to chase yield. Okay, they're not worried about Amazon, Nvidia earnings, or what MACD says. It's not how it works. And this lie is purported constantly on YouTube and by a lot of people that just don't know what they're talking about. Okay, number 3 is Russell 2000 finally get going, something to watch. Select REITs and other housing names are in play into fall. We bought some REITs for some clients' portfolios as of recent. Oil and gas names back in play, and we're going to talk about race and some other names as well. Okay, so going to the charts quickly on these, I'm just going to show you, some normalization on some of these names. So let's go over to IWM. Okay, so IWM from that June meeting. Again, this isn't like telling you the end of June. After that, the print came out. Everybody started pricing in the rate cut. Everybody's got ahead of it. Okay, so you saw it there on that name. Again, if you haven't seen normalization on SMCI, you saw it on that. If you haven't been paying attention there, it happened. Amazon kind of flattened out as well. SMCI certainly flattened out. Okay, so that trade, I mean, this is third quarter. You've pretty much traded sideways, right? The past few months, you haven't really been parabolic, sideways to lower. If we go look at, let me see what else I want to pull up. Okay, now the point again, if you're lost on this, the point I'm trying to drive home here is money flows started shifting out of the Mag 7 stuff at the end of the third quarter because smart money's paying attention to when the Fed's going to cut, where money flow is going next. Okay, so a little bit different of a story here. You had a little bit of move higher here, but pretty much down since. SMCI's got crushed as well. Okay, so there's a lot of ways to look at money flows, but the stock chart, you can just go and look. That's your answer to it. And if for some of you that need more proof, go find it. But that's kind of what I said in Q3 there on those ideas. Okay, REITs have exploded well off those lows as well. And those are my thoughts there. Okay, I'm still not a fan of anything in the broad market. I don't care about the broad market. Don't really care. Nvidia beat, but lower. Again, who cares? Goes back to rotation out of Mag 7. If you still think that this is the trade to be in, you're still not paying attention to how the world works. Okay, it's not. These things will still be tradable. These names will still be in our momentum monitor because they move violently every week. But the idea that they're going to continue to trend higher like they did with the velocity that they did from last October to May, it's not happening. Okay, money flows have moved out. They're going after small caps. A lot of REIT stuff will probably be into play as well because why? Because you're going to get a rate cut. You have to understand this in markets. Okay. This is what I said in the Sunday report. This Thursday and Friday matter again. We have data in the US and out of Europe. That should get things moving in the market. So talking about being ahead of the curve, being ahead of the curve matters for traders as well. You need to understand when is it time to get on the gas and when's there a time to do very little. Again, for those of you that are watching this show that have been mentally programmed to believe that every day is a trading day, that you have to be at your computer with 6 trading screens with CNBC on, and as soon as the bell rings, start pressing buttons. You have a rude lesson coming for you if you haven't figured it out already, but that's not how it works. Okay, the NASDAQ has priced in a $430 move for the Thursday number. It happened on Monday because of this garbage BLS data that came out. My view is you're going to see positioning into Tuesday and risk off and play, which you started to get. That area we're in on the NASDAQ right now is very, very key in my world. It's considered an inflection zone. We're going to get a large leg higher or lower starting from that point this week. Now, some of you have problems with me saying this. Again, you need to have scenarios gamed out at all times, right? Especially if you're using a technical approach. Last week we had sideways chop. That will not be the case this week. You have not got chop. It's been violent price action. That statement and analysis leads to more idea generation and momentum monitor. Okay. So again, being ahead of the curves allows you to know which names you want to be trading this week. We did in the report, those in the active trader that trade short term made a lot of money. On one of the days, the rest of the day was dead on the market. Today was pretty slow as well until end of day. Okay, so that was the report. This was from Nick Taramos. Job growth wasn't as strong in the year end in March as initially reported. This is a concern I'll talk about later. BLS revisions showed the economy added 818,000 fewer jobs than previously reported over the 12 months ended March. That would lower monthly payroll gains by 60K a month on average. Okay, this means job growth was 1.4 2024 versus reported. Okay, so again, with a lot of this stuff, it doesn't really surprise me. It's just nefarious. It's like the inflation number. It's not real either. And this is why I go back to the June article. You have to read between the lines. I said something last week on the show. I'll say it again here. If you've ever been on an earnings call before and the company's not doing well, you have to read between the lines. You can't expect the CEO to come out and be like, hey, look, our company's doomed, right? They can't come out and say that. You have to read between the lines. And, not that I believe this anymore at all, but just proof again, you've got to do not take a lot of things at face value. Okay. So this is from Liz Ann Saunders. Most shorted tech stocks tracked by Goldman Sachs soared from COVID low in early 2021 by more than 300%, but are down by nearly 72% since. Okay. So again, tech has been shorted, and it makes sense. Again, the money's flowed out of Mag 7 and into small mid caps, REITs, names that are going to benefit coming out of this cycle. Okay. Again, if you don't understand how money flows work or where portfolio managers and money managers across the world allocate capital, you're behind the curve every single time. Okay. It's important to understand that. Again, it doesn't matter if you're watching this show and you're just a day trader, doesn't really make a difference. It also doesn't matter if you use our report and you track one of our stock monitors, which is called Momentum Monitor, because again, if you go to this here, it explains what we do. These are just for day trading or holds up to 7 days. You literally just trade the monitor. It's not for analyzing balance sheets or companies. It's purely momentum driven stocks with a very precise technical overlay where you can purely trade around the order flow and technicals. Okay. This is a different mental framework versus what we do in the swing monitor. Some are fundamentals, macros, technical, sometimes all three at once. Okay. So two entirely different investing methodologies in the report. Again, that's one of the approaches that we take. Okay, so that's that there. On this is the S&P and the data for the year. Russell's going to probably outperform if we get the cut here in September. That'll crush it. S&P, again, I'm not so sure on. NASDAQ, a little bit lower. Russell 1000 as well. So again, I don't know where this is going to end up this year. I don't get paid to make predictions in S&P. It's not what we do. There's no trophies for that. If I had to give you my opinion on that, because I've been asked, I do think, which I'll explain in a second, that we probably sell off into next week on the market, and then rally into the Fed cut. How long that rally lasts, I don't know. My initial views when we had this sell-off back in July, I thought that instead of this rally I thought we were going to trade in the range. My view is that we trade sideways into the September cut, like 500-600 point ranges. Now I think we're just going to pull back, balance, and then maybe move into that that meeting. Whether we take out the highs, I don't know. Again, I don't care. There's no points for calling market tops. Again, if you're new to the business, people love to do that. Again, people that do this don't do that. So that's my final words on that. Home builders and housing, pending home sales dropped to the lowest on record. Need to fix that. But builders barely budged. Okay, my views on this sector have not changed. I do think we're going to get a short-term rally through the September rate cut. Many builders are flush with cash flow, making some names fundamentally attractive. So again, you know, I have my macro views in the market, but then when you go look at the fundamentals of some of these companies, it's hard to argue with them, right? I mean, you look at some of the balance sheets, and I'm not going to give you the names, but i- it's hard to short them. Okay, so whether this is a tactical short for 2 months or 6 months, I don't know yet. Okay, I haven't decided. The data changes. I reserve the right to change my opinion as new data comes out. If you're watching this show and you're one of those people that like to like, oh, you made a trade call and you like to be like, I told you so, or the meme those out there. You just don't trade the markets, and I just don't care what you have to say. Not to be rude, but there's been so much of that over the years that I harbor those opinions. Number three, the consumer is tapped out, and the idea that home prices will rise because rates come down is cute in theory. However, I believe homeowners are in for a rude awakening. Okay. I said this last year to Business Insider. My views haven't changed on this. Uh, look, I'm a simpleton. I'm happy to be a simpleton. There's people out there that are extremely smart. I don't think I'm one of them. The CIO of a hedge fund, again, this is a weird title. I don't like it, but the prices are not 15 to 20% as consumers start to weaken and smart money gets out of the market. Um, my thought process was pretty much the same back then that it is now. Okay. I had a short on them. I got out of them. My views right now are pretty much the same. I think you're going to get a rally into the cut. Okay. Um, but I think after that, October, November, December, when mortgage applications come in, you'll see an uptick. But I don't think you're going to see the demand come into the market like people think that they are. Okay. Right now, this is the equivalent to basically saying, okay, take Black Friday, for example. You know, whenever you see the memes of Walmart or Best Buy, you've got like the doors here and everybody's standing outside of the door waiting to get in a line. And as soon as they open the door, the TV that's $500 on sale, which is $500 2 weeks ago, but we don't talk about that, is on. Everybody tramples each other to go get the TV. That I think is the mentality for homes into the rate cut. I don't think that's going to happen. Okay, I don't think people are just going to rush like I got to buy a house now. I mean, mortgage rates have already dropped. Applications have not increased. Okay, the consumer is in trouble, and look, how can they not be? Inflation's through the roof. It's a joke. Um, it should piss you off, given what's gone on. It makes me extremely upset. Uh, and again, you've had layoffs, right? You just came through a tightening cycle, so I think it's a big problem that nobody wants to talk about. In addition to what I'll explain in a second. Okay, an oversupply of housing in the market should suppress demand and access the capital. So here's my thought process on this. I've said it before. Look, you know when you're up on a stock, some people don't abide by this because some people just like to be up money and watch it burn. But you want to sell that stock to realize the gains. You know, let's say you're up $100,000 in position. I like taking profits. I love and respect money. I like making our clients money. Okay, so I don't let this go back to 30,000 and say, oh shit, maybe it's now time to take profit. I think right now this isn't opinion, this is factual. You've seen the largest increase in housing prices ever, and liquidity is locked up in them. And people that sold were smart. People that didn't sell, I think they're in trouble. That's my view. I think when it comes time to sell, there's going to be so much, and there already is sort of, supply in the market that it collapses prices. That's my view. Okay. So pending home sales dropped 5.5% in July. This is the worst number, even worse since 2009. Okay. A sales recovery did not occur midsummer. Again, let's go back to this here. Why? The consumer is out of money. Now, there's some data that came out. 30% of mortgages have been bought with cash. Okay, cool. There's a lot of very, very wealthy people in this world that can buy homes with cash um, out there. Okay. But that still leaves a very large population. Again, I'm not saying long-term housing is doomed. I'm not saying 5 years. It's not. You've got some issues that are going to come into play. But I think the next 2 quarters, 3 quarters, you have to watch this. You have to watch to see, are some of these builders going to be in trouble for 20 to 30% off the highs? Again, right now I'm long some of them, to be clear with you guys, because I think you're going to get a trade into the rate cut that spikes them higher. But I think that might be it. Okay. This is from Nick Gurley from Reventure. I talked to them last year. One major problem for housing market is home buyers are not responding to lower mortgage rates. This guy is a great follow, by the way. Literally his entire business tracks housing. Okay. This guy was around the country. He texted me an update. He was in Dallas. He sent me some stuff. So great follow. Just follow him on Twitter. Rates have dropped from 7.2% to 6.4% over the last 3 months, and there's been no bounce in buyer demand. In fact, mortgage applications came in basically flat. Okay, so they haven't moved on mortgage rates dropping. Okay, so maybe, okay, we're gonna get a magical A, B, C, D move on this and pull back down to this, and then maybe that's where demand starts to come in when they really start to drop. You're like, okay, look, now it's time to pull the trigger. Maybe that happens, right? Maybe the Fed has to go cut, 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 cut. Who knows? Okay, I mean, nobody has that crystal ball. But my view is that it's going to be rough for a few months. Okay, so that's that there. Housing, like any other asset, people need to cash in. Many people have been extraordinary gains in their homes, and they've been diamond enhancing them, but believe that it was a fatal mistake. Commercial is another story, not my specialty, but there should be a lot of money made there. I have friends in that business that are going to crush it. It's not what I do, so I don't have an opinion on it. Like I said, I picked up some REITs for clients through the cycle that have been up already. I continue to expect them to be up there. Checking back on EOG quickly, this stock made the report last year. I'm bringing it up here now because you're close to the election. Okay, I'll give you some quick bullet points, and then we'll talk about the chart on EOG. Okay, last year this made it to the report. I talked to US World Report News about this. I love this company. I owned it for the fund last year. I owned it for client portfolios. Now, again, not investment advice. We work with accredited investors only. If you're not an accredited investor, you can subscribe to the report. For the first 6 months of 2024, they spent 1.5 billion on buybacks. It's huge. It supports the stock. Another billion on dividends. Okay, so I love that. If you can get a dividend and price appreciation on the stock, it's a double whammy. Hard to bet against that. Free cash flow is expected to increase 10% in 2025. Again, going back to the quote from Howard Marks, you want to buy well. This has been a good buy for me and client portfolios. If you get a Democratic president, these buybacks and dividends are likely to continue. So this is back on the radar as we approach October. Okay. So as we head into the election cycle, again, paying attention to what's going to happen there is a big deal. I mean, Kamala, and I'll talk about it next week in the show. You know, some of the stuff they've tried to put in for taxes is going to have a cause and effect. Even with Trump stuff, there's a cause and effect. Okay. So this is a big time the next 6 months to pay attention to the markets, especially for investors um, out there watching this show. And most of you that are investors, you know that. So I'm just repeating what you already know. We have what I think are our unique views on this to help our clients make money do that. Okay. But EOG is a name that's back on the radar. Look, I own this. Going to pay attention to it here shortly. We'll see how it goes. It's been consolidating pretty well. The buybacks have done well. I'm just hoping we come back and take out 140s on this. But again, this last February, we were long this in Valera. We crushed this for those of you in the report, by the way. If you have access to the report, go back to the archives and look at this. I mean, we literally cut all of this. I mean, to the T. Just when I say all of it, I mean maybe we sold 2% off the highs, but we were in this thing in the portfolio or the swing portfolio, not client portfolios, because the RA wasn't up then, but yeah, we crushed this in the portfolio or the report. Okay, so that's that there on that name there. And with that being said, that's the end of the show. Like I said, a shorter show this week for you guys. Not really a lot of updates there. Don't forget, issue 34 is next week. Again, if you don't have access, just click this tab there. It's free for 21 days. Okay, literally, you can download a free copy here to see what it's about. You can get access to the alerts. So again, if you don't know how to use the report, some people don't. We don't expect you to. We send you alerts. There's 2 to 5 alerts every single month. This month there are a lot more. Last month as well, because the markets have been moving. Right, we're in it literally in the eye of the hurricane, whether you guys realize it or not. Like I said to start the show, so far we've done extremely well. Again, in the month of August, these positions are still open. I can't tell you what they are, but they should do well as well. And we've just crushed it. Literally, this is all again. These are deep in the money options. These are the shares. Some people in the report have larger portfolios and buy the equity. They don't use deep in the money calls or puts. They just buy the equity. So we show you guys both. Okay, so you can get access to that there for 21 days. If that's what you're after, again, you can trial it and see if it works. Okay, so let's get into this here Q&A for the show and start with that. I've got some questions this week. And we're just going to start there. One of the questions I got, let me go through. Give me a second here. This comes from a subscriber and the active trader. basically, one sec. I gotta go here. All right, because what was the question? One thing I'd like to understand is why Nvidia dropped so hard last night and has been in a holding pattern today. I would think that with good earnings report that better than expected, they would have shot up today. What am I missing in this scenario? Okay, so look, this is a subjective answer I'll give you. To start this, there's no right or wrong answer to this. Um, but I'll give you my take as to why from doing this for a long time, and you can decide whether you believe it or not. But here's my take. Okay, look, I said it earlier in the show with this. This was the trade to be in basically since 2022. Okay. All the hot money was in this because AI was all the rage. Okay. At the end of the third quarter, you started to basically trade sideways and balance out. Okay. At a very simplistic perspective, like anything in the world, when you have more buyers or more sellers and buyers, asset prices drop. Okay. So there's no willing buyers on this, and it's as simple as it gets. And some people don't like this answer because it's so simplistic. And sometimes we like to complicate things in markets, which again, markets are complicated, but some things just are not. So I think a lot of the money flows have gone out of this already. I don't think the market cares anymore. I think back when money flows were the only trade where tech and AI names, even any little sign of like beat, you'd get a day like this. Okay. Or back in February, a day like this, you gap up. The market doesn't really care about that anymore because the hot money is moved into small caps, to REITs, to names that are going to perform out of this rate cut cycle. That's where it's moved to. So you're getting normalization of the trading activity on this particular stock. Okay. Number two, I think the market at large is going to pull back into the Fed meeting. So because this is so widely correlated to so many mutual funds and ETFs, it's just going to drag it down with it. Okay. And that sometimes that happens. Um, which is why it makes investing hard because you look at this, you're like, look, they beat earnings. How come this isn't higher? Okay. And there are factors like that that matter. Uh, that it's a real thing. Like, this is really real. And it gets confusing sometimes and it discourages people. I would say don't let it discourage you. Just keep at it and watch this show and hopefully it helps. Okay. Uh, Second question. This week were really good questions, which is why I wanted to address them. So Sue, so kind of a long question statement. I'll go here. So basically, she said, "I've quite around most of the time around here. This has been an eye-opening experience for me. I've been here a little over a year now. I feel I can pick up on things a little better. I've been trying to figure out where my place in the whole trading thing is. Stock indices strategies work for me. I finally feel like it's just starting to fall in place. Um, I just need to have the confidence in my own analysis. I know my setups, but most of all, I need to improve on exercising my mental stops. I hate jumping in and out, but I also realize I'm running my stops too tight." Okay. So the first thing is this. Okay. If you guys are exploring this business, and I'm not the first person to give this advice, there's somebody who's been in our community, Samson. Um, Sorry, I had to cut the screen there. So look, I'm not the first person to give this advice, but my insight to it is this. The first 2 or 3 years, you have to explore what works for you, and you have to just try not to lose money. Okay. And people don't like that answer, uh, but it's a reality. There's somebody in our community, Delta One. I think the interview, I don't know if we took it down from YouTube, but he was a young guy in the military. In 2019, he found me. And for 3 years, he had like $3,000, took it to like 100, 150, 250, literally to $500,000. Okay. And I'll tell you how he did it. And it was an interview. Initially, he was just trading options and futures. Okay. Then once he got to like 150, 250, 300, $400,000, he started swing trading futures, 2 or 3 contracts. He started trading oil options. He started trading stocks and holding them. Okay. So his bankroll dictated how he could hold positions, what markets he traded in, et cetera, et cetera. And one of the things he said, going back to figuring out your way, is uh, even if you don't make any money your first year, that's okay. Just don't lose a lot of money because you have to figure out what works and what doesn't and find your way. Okay. So part of the reason, again, I put this show out and part of the reason I was so adamant in this week's show telling you guys to consider incorporating Howard Marks into your routine is because it gives you a new perspective that can only help you. Okay. This isn't like one of those things in the technical trading space when I've seen the rabbit holes people go down where they're like, oh, fair value gaps and Bollinger Bands and oscillating and all this stuff, and you just get lost in this rabbit hole. And again, if this speaks to you, look, I've been there because I had a past career decade where I taught people to do this, and they were trapped in that as well. So I understand it from that perspective, but that'll give you some perspective to shift. Okay, so going back to your second question or statement rather than I told you I'd answer. Most of all, I need to improve actually my mental stops. I need to be jumping in and out. So I said to you in chat, I'll take one of those points on this show. Okay, so let me. I don't like talking about stops from a day trading perspective because there's so many different avenues to go from there that there's no right or wrong answer. I'm going to talk about it from this perspective. Okay. In the swing portfolio, when we look at the markets, and this is really, really important to understand, even if you're a subscriber that are watching this or not a subscriber, it doesn't make a difference. Listen to what I'm going to say here, because if you switch your mental model or mental framework, how to think about this, it should help you to do this. Okay. When we put on these positions in a portfolio, so let's say, for example, I'm going to pull this up to show you guys the swing monitor. Okay. And let's say we own a position in Charles Schwab. Okay. We put an alert on Charles Schwab out. We own this, et cetera, for reasons discussed. Now, when we send this out, there's different risk models. Okay. If you have $100,000 and we say, look, we're going to put a full risk portfolio position on, that means if the option costs, let's just say $800 a piece, which is $8 a contract, I can buy 5 of those options. Okay. Well, the worst mentally that can happen is you're going to lose all of it, which you shouldn't want to happen. Okay. Let's say we put a stop of 30%. Right? And we have a position of 4,000, it's $1,200 loss. Okay, so mentally before you get into it, this is your insurance premium you're paying to put on the position. So this is really what your cost of the position is, $1,200. That's what you're willing to lose. Now, additionally, what should provide solace in my view, and hopefully it does, is understanding a structure of a trade. Deep in the money options, when you have time on them, 90 days, 120 days, 150 days. We have a position on. I'm not going to tell you what it is. It's literally 7 months out on these options. They don't fluctuate like a short-term option. So for those of you that are new to this business or watching this show, you see these people create these portfolios. They're not really creating portfolios because there's nothing behind it. They don't understand how it works. This is all created on purpose. Okay, we didn't just come up with this one. Like, oh, let's just do a trade alert service, and here are our trade alerts. Yada yada. It's not like that. This is all designed because you want a low volatility portfolio. Okay, if you ever hear people, the commercials, Fidelity, Schwab, they're like, pick your rating, moderate, conservative, aggressive. Well, there's a rhyme and reason behind what goes in there. There's a rhyme and reason between this. When you trade short-term options, especially the zero DT folks, you might make $15,000 in one day or $50,000, but then you lose 15 or 20,000. So your volatility might look something like this, right? That's a potential for a lot of. When you trade a portfolio like this, your equity curve shouldn't look like that. Okay, these are all the recent stuff we've done. So even when you're losing on these positions, the losses are so relatively small because of how the idea is structured. Because you're buying intrinsic time on the option, and you're buying them deep in the money as well. So the fluctuation of the option isn't going to be up 200% one day or down 200%. And you have to understand that intimately for you to then have confidence on the positions you put on. When I put on a short-term position, trading options or futures, I know in the back of my head they fluctuate quickly because they move quickly, right? With this, I don't have that fear. Okay, so I don't know if that helps you, but for those of you watching this show that have the problem with panicking out of positions, one thing I can just say is this: you need to structure positions differently. Number two is you have to know what you own and why you own it. You have to. It's important to understand. For those of you that are short-term trading, the conversation's too long to get into. I know a lot of people like to do, hey guys, let's do our R multiples and our trade plan and a lot of generic stuff that all sounds good. It doesn't translate at all, period. Okay, so again, somebody emailed in 2 weeks ago, actually 2 people asking about active trader. Do you have a performance for active trader? No, we don't. You can't track intraday trading like that. Okay, you can track stuff like this because there's a rhyme and reason behind it. And some of you refuse to accept this because, again, just to be blunt, it goes in through one ear and out the other. Okay, let's move on to the next question. All right, so next question for the weekly show: can you cover race? It's a little overextended at the moment, so waiting for a pullback for an entry would be wise. It has a tendency to gap, kind of like BABA, but it's a way more directional. So far out, future options would probably be the way to go. It's currently at all-time highs. That could be construed as a good or bad thing to just overhead resistance, but at the same time, there are no historical levels for reference. Based on their financials, you could make a case for it or against it. However, their current future expected growth is strong, with net margins increasing. They have implemented an aggressive share buyback program with latest installment later the June this year. The wait list is 2 to 3 years. Okay, so everything you said, I agree with you there. It was in the report. We had it, I think we had it in the report. In special situations. This, again, racist Ferrari stock. I think it was in special situations. I think I took it out. It was in special situations for a while. We took it out of the report. But everything you said is correct about the buyback, et cetera, et cetera. The question is, can you cover it a little bit? Yeah, so let's go to, look, I know this, but for those that aren't familiar with it, I'll talk about it quickly here. So Ferrari has been crushing it the past 4 or 5 years. They've been on back order for 2 or 3 years. They've just crushed it there. Let's go to the financials. You know, the buyback. I don't know why it's. Why is it not showing me this? No data provided. That's not good. Give me a second. I'm going to try to pull up a value line report instead, and we'll go to that. Give me a second. Actually, we'll do this. I'm not sure why Barron's doesn't have this. I'm logged in, right? I am logged in. In fact, let me just go to Market Watch. I'll pull it up here because I don't want to use Yahoo Finance. And my value line password, it's saved. I'm one of those people that save their passwords because I don't remember all of them. It's on my MacBook. I don't have it saved in the desktop. I'm back in Phoenix and I don't know the password. Okay. So the financials are pretty strong on this. Why do I got Papa John's? Maybe I'm thinking about this subconsciously. Let's go to race and go through this. So the financials are pretty strong on this. The buyback will help. And again, no data. I wonder what that's about. You guys have to forgive me on this here. I thought they would have it. If I knew they didn't have it, I would have figured out the value line password to run through the financials with you guys. But in short, the financials are pretty solid. The dividend's not great. Don't care about that. Cash flow, I'm going to pull up here. Give me a sec. I'm going to look at my value line on the desktop, on the laptop, sorry. Operating cash flow has increased from 2022 to 23 aggressively. CapEx has decreased a little bit. They're expected to increase next year there. Free cash flow has increased pretty from 2022 to 2023 about 15%. We increased again last year. So the financials make a lot of sense on this. My concern was what you said, okay, on the structure. And that's always been the concern. You mentioned this kind of sideways action on this. I think the pause here, and I know this was in the report because we were tracking this to see what to do with it. I decided not to do anything with it. The pause here was concern of the consumer. We weren't really sure if the consumer, the high-end consumer, was going to be affected by the market at large. So you could look at like the Arnault family, which owns like Louis Vuitton, etc. You see what they were doing as well. But yeah, this is very gappy because the volume on it's not like a lot of other names. And I don't think it's widely tracked by a lot of mutual funds or widely traded. So it's extremely gappy. The question is, what are my thoughts on it? Look, would I have to pull back? Yeah, I think so. Do I think there's better ideas out there? Yeah, I do. For sure, I would expect us to pull back a little bit. I just think there might be better ideas. That's my only view on this. We had it in the report. I would have pulled the trigger on it. But again, when I was looking at this, I was gonna again. I don't like buying the shares in that because what you mentioned. There's just really no order flow in the options. I mean, very very little. Okay. So it's always been like this. So I don't really like the options play. If I was somebody who was running 100 milli on this and I could allocate 2% to it with equity, yeah, it makes sense. I think there's a lot of better ideas out there right now, but I agree with everything you said as far as the share buyback and the wait list. I agree with you, but sometimes a good idea is just not structurable. As silly as that sounds, it's just what it is. And it happens. I mean, there's been stocks. I mean, look, Alibaba, you bring that up. I wanted to invest. Look, I think Alibaba, I don't think it's any argument Alibaba's undervalued, but it's so hard to buy the shares because it's just like it's up 10% one day, it's down. So it's like it's almost uninvestable from that perspective. Okay, so look, I agree with you on that. Hopefully that helps. Maybe it's not much help. Yeah, I think there's better ideas. Okay, so I think that's it for questions this week. I'm glad we got a lot this week because I appreciate it. Not that I'm against answering trading questions, just not really what I do anymore. Right. So it's hard for me to answer questions about that stuff. Okay. I did make a video the other week on the YouTube channel. Um, it was the third question that I got about Delta and options. I made it for you guys there. Again, I don't really do that too much anymore. If you're interested in like the day trading stuff, there's somebody who I train named Brian Agile Gnome who runs like our 1 to 10 day trading approach to markets. So you can access it there through Active Trader. Again, please read this. Again, like I said before, this isn't, if you're watching this show, if you guys think it's one of these other Discord rooms, I've seen them, they're terrible anymore, where people are just guessing on earnings and YOLO trading options. It's not what it is. And if it becomes that, I'll just cancel this altogether. It's not what I want to be around. Again, we're doing long short equity investing. We're looking at things from different perspectives, and it's done well, right? You guys have seen the performance for the swing portfolios. We crushed it again in August. This will be month number 2 where we've made our readers a lot of money. And hopefully we'll continue to do that in September. I think we will be able to with a Fed cut because, yeah, there's things are in play, right? And that'll be it. So if you want access to this, go to the website, trial it. I look forward to having you as a reader to the report. So, look, that's going to do it for this week's show. Ahead of the curve, like I said, it was going to be a shorter show this week. If you have questions, go to the website. If you're not a subscriber, you can go to the About tab, hit the contact. You can send it if you're a subscriber. Just send me a message. You guys have my DMs, and I'll answer them from there. So that's going to do it for me. Thank you guys for watching. As always this week, have a good weekend. It's a 3-day weekend. The report will be out Monday. I have some updates for you guys, and I think we're going to get some risk off next week. All right. See you guys next week. Thanks for watching.